Every night, after the markets close and you're thinking about dinner, the most important financial transaction you've never heard of takes place. Banks that literally printed money today suddenly need to borrow billions before sunrise. Other banks who have too much cash sitting around become overnight lenders charging interest on loans that vanish by morning. The number that gets moved around in these few hours? Over $4 trillion. Every single night. And in September 2019, this invisible machine that quietly powers the global financial system just stopped working. Interest rates that normally sit around 2% suddenly spiked to 10% in a matter of hours. The Federal Reserve had to inject $75 billion in emergency cash just to keep the lights on. You probably don't remember hearing about this. That's by design. Because if people understood how fragile the plumbing actually is, they might ask uncomfortable questions. Here's the thing about modern banking that nobody wants to say out loud. Banks don't actually have the money they claim to have. Not because they're criminals. Because the system is designed that way. Your bank is legally allowed to lend out about 90% of everything you deposit. They're basically running on 10% battery at all times. This works fine until everyone shows up at once asking for their money back. Then you get 1929. Or 2008. But there's another problem that happens every day at a smaller scale. Banks need to hit certain reserve requirements by the end of each day. It's a regulation. If they loaned out too much money or had unexpected withdrawals, they're short. So they borrow from other banks. Overnight. And pay it back the next morning with interest. This market is called the repurchase agreement market. Repo for short. And it's not just banks. Hedge funds use it. Money market funds use it. The entire shadow banking system runs on it. The repo market is essentially the financial system staying alive one night at a time. Let's say you're a bank and you're $50 million short of your reserve requirement by the end of today. You can't just not meet the requirement. The consequences are severe. Regulators get involved. Your stock drops. People start asking questions. So you go into the repo market. You find another bank or institution that has extra cash sitting around earning nothing. You offer them a deal. Give me $50 million right now. I'll give you U.S. Treasury bonds worth $50 million as collateral. Tomorrow morning, I'll buy those bonds back from you for $50 million plus a small interest payment. Maybe $50,000. Deal? That's it. That's a repo. It's technically a sale and repurchase agreement. But really it's a collateralized overnight loan dressed up in financial language so it doesn't trigger certain regulations. The interest rate charged in these transactions is called the repo rate. On a normal day, the repo rate hovers just slightly above the Federal Reserve's target rate. Maybe 2 to 2.5% annually, which works out to almost nothing for one night. Banks borrow billions. Pay tiny amounts of interest. Return the cash the next morning. Everyone goes home. The system is so boring and reliable that most people who work in finance never think about it. Until September 17, 2019. That morning, the repo rate was sitting at around 2%. By afternoon, it had jumped to 5%. Then 7%. By the time the market closed, some overnight loans were being made at 10% interest. For context, that's credit card territory. For an overnight loan. Backed by U.S. Treasuries. The safest collateral on earth. Something was catastrophically wrong. Banks that desperately needed cash to meet their reserve requirements couldn't find lenders. And the lenders that had cash were demanding panic-level interest rates because they weren't sure they'd get paid back. This is not supposed to happen in the American financial system. The Federal Reserve had to step in with emergency funding. $75 billion on the first day. More in the days after. They called it a technical issue and temporary disruption. But here's what actually happened. Corporate tax payments were due that week. Companies withdrew hundreds of billions from banks to pay the IRS. At the exact same time, the U.S. Treasury was settling new bond auctions, which pulled even more cash out of the system. Suddenly, every bank needed cash at once. And nobody had extra to lend. The machine stopped working because everyone hit the ATM at the same time. Now here's the part that should bother you. The repo market is supposed to be the backup system. The safety valve. the place banks go when they need emergency short-term cash. But the backup system needed a backup system. And that backup system is the Federal Reserve, which means it's the government, which means it's taxpayers. When the private financial system runs out of liquidity, the public system has to create it out of thin air. You might remember this from 2008. Different crisis, same solution. But 2008 was a once-in-a-century financial collapse. 2019 was a Tuesday. The Fed's response was to start something called overnight repo operations. They essentially became a permanent lender in this market, offering hundreds of billions in overnight loans whenever banks need them. This was supposed to be temporary. It's still happening today. Here's where it gets weird. The repo market was originally designed as a private solution. Banks lending to each other. No government involvement needed. But over the last 15 years, something shifted. The big banks got bigger. Regulations got stricter after 2008. Banks now have to hold more reserves and can't lend as freely into the repo market as they used to. At the same time, hedge funds and other non-bank financial institutions got more involved. They started using repos not for emergency cash, but for leverage, borrowing against treasuries to make bigger bets. So you have more demand for overnight loans and less supply from traditional lenders. The gap gets filled by the Federal Reserve, which means the Fed is now structurally embedded in a market that's supposed to function without them. They've become the lender of first resort, not last resort. And nobody's really sure what happens if they ever try to leave. There's a philosophical problem hiding in here. If banks can't reliably lend to each other overnight without government intervention, are they actually solvent? If the answer is only with Fed support, then we're not really running a private banking system. We're running a public-private hybrid that pretends to be private until something breaks. And things break more often than you'd think. 2019 wasn't even the biggest repo crisis in recent history. In 2020, when COVID hit, the repo market froze again. The Fed had to inject trillions. Each time this happens, the intervention gets bigger and the market gets more dependent. It's like a drug. The first hit solved the problem. Now you need it just to function normally. Here's the absurd part. U.S. Treasury bonds are considered the safest, most liquid asset in the world. You can sell them instantly for cash anywhere on the planet. But in the repo market, banks are using these ultra-liquid assets as collateral to borrow cash overnight because they don't have enough liquidity. Think about that. They own the most liquid thing in existence, but they still need to borrow cash. But because the treasuries are being used somewhere else, or they're the wrong maturity, or they're locked up in some regulatory requirement. The system has become so complex that you can own infinite money in one form and be desperate for cash in another. So every night while you're asleep, $4 trillion gets shuffled around in a market most people don't know exists. Banks borrow from each other, or from hedge funds, or increasingly from the Federal Reserve itself. By morning, the loans are repaid. The collateral is returned. Everything resets. And we do it again the next night. This system has worked for decades. It's the financial equivalent of your heart beating. You don't think about it until it stops. But it has stopped. Multiple times. And each time, the solution has been more government intervention in a market that's supposed to be private. At some point, you have to ask, if the plumbing needs constant emergency maintenance, is the problem really temporary? Or is this just what the system looks like now? The uncomfortable answer might be that the financial system runs on overnight loans because it can't run any other way. And the only reason those overnight loans still work is because the Federal Reserve is standing in the shadows with unlimited cash, ready to step in the moment things get weird. Which they will. The question isn't if. It's just how many more Septembers we have before everyone notices.